Hey, good afternoon and welcome. My name is Matt Price. This is Matty Kearns of the Price Group, and we are here for the October monthly market update. A big few weeks coming up here with the election. Have a few slides to discuss that, but we can go ahead and get started. Our goal here is to be 15, maybe 20 minutes long. The thought behind these is not necessarily to cover every topic in great detail, but use this as a catalyst to reach out to us if there are any specific questions about the markets, etc. We'll be recording this and sending a replay to all clients as well. Quite a few familiar faces, or names at least, on the call here, and a few new names as well. For those of you that are not as familiar with us, we are the Price Group. Randy would try to tell you he's my older brother, but don't let him fool you. He's my father. Randy, myself, and Matty make up the three advisors of the Price Group. 50 plus years of experience between us. We follow a fiduciary standard, which we think is really important. And over the years, we've come to kind of be the retirement guys. We have a retirement niche where over 80% of our clients are in fact retired. The vast majority of the other piece of our client population are on the eve or on the cusp of retirement. So retirement's really all we do, and we love that. We think in retirement you actually need a specialist, not a generalist, who can help anyone with anything.
A little bit more about us, get to brag on Matt and Randy a little bit here. Both of them have been recognized by Forbes over the years. Randy Barron's for a number of years, so I know, and our team as well, honored to receive those recognition. We also believe education is very important in what we do. Matt and Randy studied at Wharton before they got their CIMA, Certified Investment Management Analyst designation. And then all three of us are certified financial planners. Again, education we think is key in our line of work, as well as those certifications. A lot of people ask, clients understand, but prospective clients might not. What is the Price Group? Who are you? Who is Raymond James? Who is Steward Partners? The Price Group, our team that we've been talking about, we're essentially the Houston office of Steward Partners, our firm. Steward Partners has about $37 billion in client assets as of this summer, not owned by a bank, owned by the partners. And on a day-to-day basis, the investment activity that happens at Raymond James, our primary custodian. So that's where assets are held. They're a conservative company listed on the S&P 500, and they've been a really good partner of ours over the years. So with that information, we'll get going on our market commentary here, Matt.
So we think as it stands today that there's a sunny forecast for the U.S. economy. Let's drill into that a little bit more. The consumer, which, as many of you remember, represents about 2/3 of the overall GDP, or the gross domestic product, or think of it just as the entire economy. And the consumer is supported by job growth. So if there are more jobs being created, the consumers are typically spending more. If jobs are being cut, the consumer typically will reduce spending. But you've seen there on the left, job growth has been pretty steady. So not any big months of job growth here. So far this year, they've been pretty tame in that 100 to 150,000 per month addition category, which we think is good. The other big segment of the economy is what are businesses spending. And you can see there in the middle, business spending remains robust, specifically in the technology area with artificial intelligence, chips, etc. And there's actually some, hard to believe this third one, but some untapped money of government spending that has not been spent on fiscal stimulus. And so, if the government's good at anything, they're good at spending money. We anticipate this to be spent at some point here in the coming months, rolling into next year. But overall, we're still positive on the economy. The question we get a lot is, do we think it's going to be a hard landing or a soft landing? Hard landing would just mean that there's a recession. A soft landing would mean that we can come out of this without having a recession. Right now, our base case is we think we can avoid recession just based on the continued new job growth, how we think the consumer is still in a good spot, and companies as a whole have a bunch of cash on their balance sheet. So on that same note, we do have a 2% growth rate from Raymond James with growth over the next 12 months. And when you put that into perspective there on the right, the current expansion in line with historical expectations, you can see starting, if we want to kind of draw a line in the sand in the spring or summer of 2020, when the market had a decline and started to move higher, the magnitude of the expansion is something that we compare to past, and you can see there at the bottom, the average of all periods is 24%. The average dating back to the early 80s is 27%. What does this mean? This means with the current expansion where it is, we think there is still room to run. So we're not of the opinion that the market has reached all-time highs and there's going to be a 20 or 30% pullback here in the short term. In the same breath, we are also not of the opinion that the market is up 20 or 30% over the next 12 months. The market's actually had a really good run here for the first, call it 9.5, 10 months of the year. And while the last few months are typically the most positive year over year, we've got out to a much quicker start than I think most any economist would have forecasted at the beginning of 2024. So we think that we're going to be in kind of this choppy market. Stocks might be up 5%, stocks might be down 5% here for the next few months, especially with the election upon us. If that's the case, we think the best place to hang out as it pertains to your stock portion of your portfolio is in dividend-paying stocks. Clip the proverbial coupon as we wait for stocks to move higher.
Switching now to inflation. We've heard about the soft landing, the Federal Reserve cutting rates, hoping to achieve that soft landing. The main reason that the Federal Reserve can cut rates is because inflation does continue to decelerate. It's getting closer to their 2% target, but can they continue to do that? Anecdotally, we're seeing ads on TV, and I'm sure you're getting stuff in the mail. Retailers are running promotions. Amazon just did, an October Prime Days, Walmart, Target, they're all doing it. Restaurants have deals. And what does that tell us? That tells us that the prices of goods will continue to be contained, right? For the past few years, there haven't been as many deals, but you can see retailers kind of getting back into that game a little bit more. And we think it's really important to focus, the Fed is focusing on as well, the pace of inflation, not the level of inflation. You can see that inflation shot up since COVID, and there's nothing that the Fed can do about that looking backwards. We don't want deflation. They can only focus on the path forward from here. And the goal is to be around, if you can see that, 2.1% going forward. And you can illustrate that by looking at a few categories here on the right. What's happened since 2019 and what are we seeing now? You look at used vehicles, 24% inflation since 2019, but over the past year, we've actually seen a little bit of a decline. And, you look at stamps are up to, I think, 73 cents now. That's 55% up since 2019. But they announced recently that there's going to be no change come January. So there's some good news there. Again, it's the pace of inflation that they're focusing on, not necessarily the level of inflation going forward.
So a little bit about the election. We think whatever happens to Pennsylvania probably is the outcome for the entire election. That's not just our opinion, but you've heard both Republicans and Democrats kind of come to the same conclusion on this topic. And we don't pay as much attention to the polls. We think the polls have actually become a little more political than we would like. We've paid a little bit more attention to the actual betting markets, people who are placing wagers on the presidential election. And if you look at that, Trump has a slight advantage, but obviously quite a bit of ways between now and election day. We'd encourage you to not only get out and vote, but get out and vote early. especially here in Houston. They're expecting to have real congested wait lines for election day. So I think Matty voted this morning. I voted yesterday morning, and there's no line with where we went. So, but Pennsylvania, obviously the main state to watch. A number of the other swing states, it still looks like it's within the margin of error. Typically, people will assess that 3% number to the margin of error for some of the polling figures. And we think the major policies to really watch here with the election are tariffs. What happens to the tax cuts that were put in place in 2017? Are those continued, or do those roll up? And then the biggest thing, which honestly Republicans and Democrats both have been poor at, is the national debt. And it's a staggering amount, no matter how you really divvy it up on a per person basis, a per family basis. And that would be something clients sometimes will ask us, what keeps you up at night? And this would be our answer over a long period of time. Something needs to be done. You've heard probably Elon Musk, the founder of Tesla, has been very vocal and in support of President Trump to get reelected. But he's going to be the one that, if Trump was elected, go in and I think they called it the government efficiency police, and see if and where there can be some proverbial fat cut across the government to reduce national debt. And whether it's now or later, it's going to be us or our kids or our grandkids are ultimately going to pay the price. And it's the best time to plant a tree was 20 years ago. The second best time is today. We're of the opinion that something needs to be done on that front.
Switching now to the bond market, the good news, bonds are behaving like bonds again. What does that mean? Consistent income and portfolio stability. So consistent income, you can see bonds across the board are now yielding 4+%, which is higher than the 20-year average in the light blue and much higher than the COVID low from 2020. Bonds are actually producing income now, a good starting yield, but they're also behaving like the ballast to the ship. I'm sure many of you have heard that. Bonds are added to portfolios to provide stability when paired with stocks. The idea is that stocks and bonds move in opposite directions. And that's what the chart on the right is showing, that the stock bond correlation is negative again. They're negatively correlated. So when stocks go down, bonds go up. And that's the traditional benefit of risk reduction and diversification in a portfolio. So good news that bonds are behaving like bonds again. And then within bonds, we still favor the higher quality part of the bond market. So that's higher grade corporates and then municipal bonds as well. 5 reasons to favor high grade credit right now. The economy is growing, positive earnings growth for corporations, so less defaults. The rating agencies are issuing more upgrades than downgrades. Again, just like we talked about, positive yields, more stable income, and then there's actually strong demand for bonds as well. For a lot of our clients, they're very focused, or municipal bonds can be a big part of their portfolio. And what we're seeing here is the advantage of municipal bonds from a yield perspective compared to United States Treasury bonds. So from 3-month bonds out to 30-year bonds, the blue line are US Treasury bonds. The light blue line is the tax equivalent yield on municipal bonds. And you can see across the curve, 3 months to 30 years, you're getting more income on a tax equivalent basis with municipal bonds right now. And who knows what's going to happen in a couple weeks, but if tax rates do move higher, this benefit becomes even more substantial. So we still do favor municipal bonds right now when we're looking at the whole bond market.
The U.S. remains the oil capital of the world. That should be reassuring to the fellow Houstonians on the call, but I think it's pretty startling looking there at the left on how Saudi Arabia has cut so many barrels, or OPEC in general, and the U.S. production has continued to climb. So we think this is good, not only for the national economy, but more specifically to the local economy here, with oil and gas being such a big piece of that. And here, this slide and the next slide, we have a few conditions we think that the bull market is set up well for the long term. We'll look at number 2 here on this page. Earnings continue to move higher. So you want to take all of the noise out of investing in stocks. Stocks will move higher if and when their earnings move higher. Or maybe said another way, stocks will move higher if and when the expectation of earnings will move higher. And so we've seen just that. You saw a big downturn there in 2020 with earnings, but most all companies recovered rather well, and earnings have continued to move higher with a little blip there during 2020. You remember the stock market as a whole was down about 19% in 2022. But we think that earnings will continue to move higher in that maybe that middle range of the single digits. So 5, 6, 7% is our estimate here over the next 12, 18 months. And then for a few more reasons why we think the bull market is set up, slower inflation. Matty already kind of talked about that in detail. We think that the inflation metric is getting close to what the Federal Reserve wants of that 2% number. You look at number 4, investors continue to have record cash. This is a big one. There's just more cash sloshing around in money market funds than there ever has been dating back to 2007 on this chart. So what that means is at some point that money moves off the sidelines from money markets into the market, whether it's the bond market or the stock market, which should provide some proverbial wind at the back. And the other thing we pay a whole lot of attention to are the dividends, but also the buyback policies. So buyback policy, as a reminder, this is when companies are buying back their own stock, and companies will not buy back their own stock if they think it's expensive or if they think it's going to get cheaper in the short term. Typically, you see companies buying back their stock when they think that their stock price is going to move higher over the next 3, 9, 12, 18 months. So we think the bull market is here for a while now. Obviously, that's with the caveat, we don't know what we don't know, meaning if there was some type of World War III that erupted, if there was something like that that is completely unforeseen, that would cause us to change our thoughts on this. But from what we can tell now, the economy, we think, is and continues to be in good shape. So that's all we had, just right there in that 15 to 20 minute mark. Please, if you have any questions on this, pick up the phone, give us a call, shoot us an email. But I'm Matt Price, that's Matty Kearns, Randy, and then alongside Tiffany, Melissa, and Preston. And we want to thank you for spending a few minutes with us. So if no questions, we will sign off from here and look forward to hopefully catching up soon.